we have a lot to cover, so I want to get into it. We're going to break this up into two. So we're going to start off by talking about your expenses as a landlord, business expenses, right? Because you should be looking at this as a business.
Yes.
And then we're going to get into your write-offs and deductions.
So basically, according to IRS terms, expenses are anything that is ordinary and necessary for you to run your business. Ordinary and necessary. And again, rental property is a business, and it should be run as a business. And every deduction, every dime that you put out to manage, to operate your property is a deduction, as long as it's ordinary and necessary. So what do we mean by ordinary? A doorknob, you replace a doorknob. Yes, that is necessary. If it was broken, if it was defective, you need to replace it. So it's necessary. However, if you say it costs you $2,000 to replace it, that is not ordinary. The IRS clearly knows that a doorknob does not cost $2,000. So keep in mind that these ordinary expenses, what they mean by ordinary is ordinarily, what would it cost? What would it cost? And you have to apply a common sense parameter when you outline your expenses.
Yeah, that's so when it comes to things like computer, iPad, AirPods, I know that a lot of people do write those things off because it's part, maybe they're taking their calls on that. I mean, you can speak to that.
And yes, that is a very good example of something that is needed, but do you use it 100% for your business? If you can justify that you use it 100%, I bought this computer for my property, this is all that I use it for, then you can write it off 100%. However, if you have one property, is it realistic that you're using that computer for just the management of that property? No, it is not. If you have 20 properties, is it realistic that you bought that computer strictly to manage those properties? Yes, it is. So this is where you're conversating with your preparer, the person that is doing your taxes, and them applying a common sense approach to those types of things comes in.
And that was one of my questions. How often should you be speaking with your tax professional? Because I know a lot of times you get your taxes done, you do them once a year, right?
Right.
But you're doing things throughout the rest of the 360 every day,
Right.
So how often should you be connecting with your professional?
I always advise, now, if you're using your professional for bookkeeping, then you should have a regular schedule of time when you're at least transferring information to them and maybe saying a few words about it. If you're not using your professional for bookkeeping, I tell my clients, before you put out any major money, call me. You made a purchase, you called. Would it be better for me to do it this way, or would it be better for me to do it that way? And then I'm going to give you some pros and cons on both sides. And of course, the final decision is up to you. But you should always speak. Don't take $80,000 out of 401k and then call me after you took it. That's not going to help you.
Too late.
That's not going to help you. So anytime you're going to do something major, you need to talk to your tax professional.
Yeah, that's a good rule of thumb. Anytime you're going to spend a large amount of money,
right?
You need to consult.
Yeah.
Yeah, that's a good point.
I mean, an example would be someone calling and saying, I need to get a new vehicle for my business. Should I lease it or should I buy it? Then I can tell you the pros and cons of both. I can tell you what I think as your tax professional best fits your situation. but the ultimate decision is up to you.
Mm-hmm. Yeah. Yeah. So as you touched on a little bit about business. First, do you need to have an LLC to be considered a business? And when does the IRS, or when are you considered to have a business? Because a lot of people still they're not clear on, well, maybe I have one property. Is that's still a business?
Mhm.
Yeah.
It is.
So when are you considered to have a business? Do you need to have an LLC for that? And
Okay. You don't need to have an LLC to operate a rental property.
Mhm.
However, the LLC does give you protection, liability protection. Most rental properties are owned, and it's becoming more common to see them owned as LLCs now, but back in the day, they were owned as sole proprietor. You would be considered a sole proprietor. It doesn't require any special licensing. It doesn't require you go to town hall and get a business license. The fact that you own the property, that you rent the property out, you must be renting it, then you are considered a business. Again, putting it under an LLC gives you added liability protection should something go wrong. Should someone fall and sue you, they're not going to sue you personally. They're going to sue you through the LLC, which is going to give you more protection, but it's limited. That's what an LLC is. That's what it means, limited liability corporation. So it's not the cure-all for lawsuits, but it does give you more protection than if it was in your name solely. But do you have to be an LLC to be considered a business? No, you do not.
Mm-hmm.
There are different business entities. You start as a sole proprietor, then you can become a sole member LLC, which is really considered the same as a sole proprietor, just a little bit more protection. You can become a multi-member LLC, which makes you a partnership, or you can become an S corporation. And last is a C corp, which the average person would not want to be a C corporation. Obviously, there are more taxes involved.
Mm-hmm. Yeah, there's so much misconception with the classifications.
Yes, there is.
There
is. My biggest thing I hear is, I'm an LLC. Are you a corporation? I'm an LLC. LLC is not the same as being a C corp. Mm-hmm. Or an S corp. These are designations that when you set yourself up as an LLC, you must request of the IRS to treat you as an S corp or a C corp. I don't know why anyone would want to be treated as a C corp. So primarily it's S corp status. But for rental property, typically you're looking at sole proprietors and you're looking at LLCs, whether they're sole member LLCs or multi-member LLCs.
Mm-hmm. Yeah. Okay. Thank you for clarifying that and breaking that down a little bit. One of the other questions that I see a lot from landlords is how they should manage their records so that they're prepared for tax time. There's so many things that you can take deductions and write-offs for. How do you track those things? What's the best way that you see, or how do you prefer when someone comes to you and they have their records this way? What's that like? What's that way?
What I prefer is to just give me a profit and loss statement. Do a worksheet, document your income. You know what your income is. You collect your rent every month. Mm-hmm. You collect your first month's rent, your last month's rent. Give me an income portion and give me an expense portion. Every expense, everything that you put out, label it and put it into a profit and loss statement. Hold your backup material in case I have questions, and in case the IRS has questions. Hold that, but I don't need that initially. I would only need that if I saw an item that just did not look ordinary or necessary to me. Then I want you to prove it. I want you to show me, okay, where's the receipt for this $2,000 doorknob that you bought? I'd like to see it.
Mhm.
But basically, profit and loss statement, Excel spreadsheet, doesn't have to be fancy and complicated. It basically just needs to be what you brought in and what you put out. It's one of the simplest methods available for business owners. Most other businesses have to really provide substantial, I asked for their bank statements, a lot of substantial information. Rental property can be very clean if you do it right.
Mm-hmm. And you kind of do it on a regular basis, which is what I recommend. I don't always do this myself. I'm working to get better at it.
At the very least, you should do it on a quarterly basis. It would be nice to do it monthly.
Yeah.
But on a quarterly at the very least, so that you're not overwhelmed in the end. Because what happens in the end, when you wait, you miss things.
Mm-hmm.
You misplace something. Where did I put that receipt? Where's this? Where's that? The ideal situation is to have a separate account for your properties and run all your income and all your expenses through your property. And if you do that, and you haven't done a profit and loss statement, you can simply give me your bank statements and I can do your return. But when you give me a bank statement that's got Food Lion, groceries, Marshall's, Disney World, everything and under the sun in it, that becomes a very difficult situation of trying to extract what expenses and what income was actually part of your rental property, the operating of your rental property. So clearly, it is much easier for you as a property owner and for your tax professional if you run a separate account for your rental property or properties.
Right. So do you recommend when it comes to certain expenses, business expenses, right? Your mileage, or maybe your anything related to the vehicle that you're using for business. Do you recommend keeping
a log?
Log of all of those things.
A log, or there's lots of tracking devices that can be downloaded for free on your phone, where when you're going to the supply, if you're managing your property yourself and you're going to the supply store to get supplies, track it. If you're going to your tenants, to your property, collect rent, track it. If you do that every month, you only got to track it one time, and then it's time 12. If you manage your property yourself and you mow the lawn, same thing. How many times did you mow the lawn? Track it the first time, multiply it by the number of times you went, and take those totals for those different events. And there you have your mileage.
Yeah.
Which, by the way, is an expense that a lot of property owners don't track. Mileage involved in servicing that property. Now, as a property manager, if you're managing a property, then your mileage becomes important as well. And you definitely should keep track of how you use your vehicle to service your clients.
Yeah. So for me, I know we do this because, I work for a professional management company. Right. So it's like second nature to me. As soon as I'm driving there, I'm tracking it, second nature. So, okay, you covered, that was some good information there. Before we move on to write-offs and deductions, can you give us a little bit on 1099s? And what is a 1099? And do landlords need to provide this to their vendors, contractors?
Okay, let me go back to expenses quickly though. I want to talk about repairs versus capital improvements. A lot of times a property owner will say, I replaced my roof, and they will put that in their repair column. That is not a repair. That is not 100% deductible in the year that you did it. That is a capital improvement that has to be depreciated over a certain amount of time. That is a big area where property owners don't clearly understand. So capital improvement is adding to the value of the property. It is not a deductible expense. It is amortized for a certain number of years. So something like a roof, you come in and you completely redo your electrical system, redo your plumbing. Those are not expenses. If you replace a toilet, that's an expense. If you put in a new fuse box, that's an expense. If you replace all the copper plumbing, that's a capital improvement. If you replace the wiring, if you totally rewire the house, that's a capital improvement. So property owners need to be conscientious and understand the difference between a repair versus a capital improvement. And again, I wanted to mention that because that is an area where many property owners have a misunderstanding.
Yeah, so I'm glad you brought that up. I do have an episode where I go into more detail on repairs and then CapEx. You know, you're looking at something that's extending the life of this item. So I do try to, because I do see that that's early in the business, I didn't understand the difference. So, you know,
yeah,
it's
a big area of misunderstanding. Okay.
Okay, so 1099, what is a 1099 and do landlords need to provide this to their vendors and contractors?
The IRS says that anybody who pays out over $600 to any individual is supposed to provide a 1099. If you're paying out to a corporation, then it is not necessary. So basically, do people do it? No. But the IRS does say that you are supposed to do it. It's showing, it's proof that you paid out this money. So potentially, you could have a line item that says you paid out $1,200 to someone. Let's say you're the person who cuts the grass for your property. Let's say you paid him $1,200. He's a landscaper. He cut the grass and he planted some flower beds, and you paid out $1,200 to Joe Smith. You're supposed to give him a 1099, because what the IRS is trying to do is they're trying to close the gap on money paid out and money reported. If you paid out $1,200 and did not give this gentleman a document to show, he is not putting that on a tax return. You give him a 1099, if he doesn't put it on a tax return, he will be receiving a letter within 6 weeks from the IRS. So they're trying to close the gap on unreported income. And the rule says $600 or more, you are supposed to give a 1099. So it is an income document. What is it? It's a reporting document to show income received by an individual and some companies, but you do not have to give it to corporations.
Okay, so if you don't, is there a penalty for not providing that?
At this time, no. However, at the IRS discretion, they could disallow you deducting it.
Yeah. Okay.
You know, this is relatively new, and it's in the beginning stages as far as monitoring and any repercussions for not doing it. But I do, you know, it is a rule. So the rules are made to be followed.
Yeah. Follow the rule. Just get into practice now before
Correct.
you.
Correct.
Yeah. Okay.